Welcome into Thimbleberry U. I am John Jagay, joined by Amy Walls. Amy, it is our 50th episode.
Woo, woo!
It's been a pleasure working with you all this time. And as we get into the fourth quarter of 2021 and start approaching tax season and things that folks are thinking about regarding their taxes, today's topic has to do with our listeners and maybe even our listeners' parents. This is very valuable information today, talking about Qualified Charitable Distributions, or QCDs.
Yes, this is such a fun and underutilized strategy for folks that, you know, like you said, I'm not sure how many of our listeners fit into the age group to do this, but I know a lot of our listeners have parents that do, and a lot of our listeners are charitably inclined. Mm-hmm. And so I think this is just a win-win and a great way to celebrate episode 50.
Okay, so what is a Qualified Charitable Distribution? Again, QCD.
Yeah, well, Jag, to get into that, I need to talk first about required minimum distributions, or RMDs. Mm-hmm. A required minimum distribution happens when someone reaches age 72. It used to be 70 and a half. So a required minimum distribution is when basically Uncle Sam comes and knocks on your door and says, "Oh, thank you. You've used a retirement plan. And that money wasn't taxed when you put it in. It's now grown. And we want some tax money. So guess what? We're going to put you on a schedule to force you to take that money out." And they don't explain their reasoning, of course, when they do that. If you don't take out the amount required, it is a 50% penalty before taxes.
One of the steepest penalties in the tax code. Then it's time to take that money out. You best be taking it out.
Absolutely. So understanding that, and before I move on, there are required minimum distributions on inheritances through retirement plans. This topic, I really want to talk about the age 72 or earlier 70 and a half, because there's still a little small group of people that are still operating, needing to take RMDs that have not yet reached age 72 that this could apply to.
Okay, got it.
But there's not a lot of them left. Probably have about 6 months left of those. So a QCD, or Qualified Charitable Distribution, is a way to meet the required minimum distribution. So Jag, if it's you and you were that age, I know you're not. But if you were, you could get the credit for having taken the money out, but you would not actually receive any of the money. You would not be taxed on any of the distribution, and you would get to give it to charity.
Ah, sounds like a win-win all around.
Absolutely.
So I'm taking the money out, but rather than keeping it, I'm giving it to charity, and by doing so, I'm not being taxed on what's coming out.
Correct.
So does this give me a write-off on my taxes? How does that part of it work?
Great question, and no.
Okay.
I didn't answer it. Depends.
Your favorite answer?
I know. So no, you don't get two tax benefits from doing this. The write-off you're really referring to is an itemized deduction. Mm-hmm. Itemized deductions lower taxable income.
Okay.
Tax calculations are based on something called adjusted gross income.
Okay.
And a qualified charitable distribution lowers that adjusted gross income, or AGI, and happens before the tax calculation is done. Therefore, the qualified charitable distribution lowers someone's actual tax bracket, perhaps, or where they sit in that tax bracket, because they're like stair steps. Mm-hmm. And so that will allow them to pay less taxes. The other important thing, Jag, is that it also, by lowering that AGI, adjusted gross income, it also potentially allows them to still qualify for the itemized deductions that you're talking about, but not in terms of the same money being donated to charity.
Okay, so it lowers the AGI, could make you eligible for other itemized deductions.
Yeah, and what I mean by that is that at a certain income level, adjusted taxable income, you lose the ability to itemize as many things.
Ah, so this could potentially get you below that number. Got it.
Exactly.
Okay, so who's eligible to do this, Amy?
Individuals that are required to take a required minimum distribution from a traditional IRA. So this does not count from a 401k or a 403b. It's traditional IRAs only. And they need to be over the age of 70 and a half, or really 72 if they reach 72 after the rules changed.
Okay. So we know who can do this. We now know the benefits of doing it. What are the instances where people should consider doing this?
Yeah, I think the first thing that I'd say on this is somebody who's charitably inclined,
Sure.
right? I don't think it's right if you're not charitably inclined to start doing it just to save money. It doesn't feel right. Those people that don't need their required minimum distribution to live off of,
Okay.
but still have to take one, meaning that the distribution gives them more cash flow than they would otherwise spend. And so this could potentially decrease their tax bill because otherwise it's just higher as a result of extra money coming out of retirement plans.
Right. There are folks who are going to need their RMDs to make ends meet and pay their bills. There are others who have other sources of income and don't need that specific RMD money. So if you don't need the money, this is a great thing to do with it.
Absolutely. The other group that I think fits this, and I talk to clients about this quite a bit, are individuals who do need the funds from their RMD, right? They just don't have such large retirement accounts that there's a lot of extra money flowing in and getting reinvested as a result of taking these annually, but who give in other ways. So monthly tithing, for example, is a good example of that. Maybe they're giving $1,000 a month as a tithe. That's $12,000 a year. Well, maybe we stop the tithing on a monthly basis and do one $12,000 qualified charitable distribution instead.
And that can be tax advantageous depending on the individual situation.
Exactly. Another place that we see it is sometimes clients make multi-year commitments to a charity. Maybe it's a capital campaign or something to that effect. And they're, going to give $10,000 a year for 5 years.
Okay.
This is a great way to cover that and not have cash flow impacted.
Ah, okay. I like that.
And save some money.
Got it. So I'd imagine, like all things, there are some rules involved here, Amy. What rules do folks need to be aware of if they're going to wade into these waters?
Well, it depends. No,
I knew
it
you'd
doesn't.
say that.
I just had to get it in there. This is our second podcast in a row where I don't think I've answered that way. So the first thing I'd say is the age at the time of the distribution. So let's use 72 here, for example. You need to have reached the RMD age at the time you take the distribution. This only applies to traditional IRA distributions.
Okay.
Okay, so sometimes people might want to do this from some other type of account. It's only traditional IRAs. The organization you're giving the money to must be a 501c3. And you need to have a receipt.
Get your receipts. Have those receipts.
There is a $100,000 annual cap per person on doing this.
Okay.
In our last episode around the house tax bill, we talked about how the proposal is that if people's retirement plans are over a certain threshold, they'd have to take excess required minimum distributions. Someone might think, oh, well, gosh, I'll just do this, right? That's really going to help the income. It's not, because there is a $100,000 annual cap.
Okay.
It's also important to note that that's individual. So couples, if they're both of the right age, would need to each process $100,000 from their own account, the individuals. You can't consolidate and say, well, gosh, my husband took $200,000 from his account, so $100 of that was mine because I took my normal distribution. It's $100,000 each.
It doesn't work that way. Got it.
Yeah. Qualified charitable distributions must be paid directly to the charity. So, Jag, let's say you decide, hey, I'm going to do this. For a distribution from an IRA, you're always going to have to fill out a form. And you receive the funds and then say, I'm going to give that to the charity. It doesn't count.
It's got to go directly to them out of the account.
The custodian makes the check out to the charity.
Got it. Okay.
The last one is a pretty big one, too. Jag, let's say, and I know I'm picking on you a lot today as possible qualified charitable distribution mistakes, right?
I'm fine. I'm an easy target.
Jag, let's say that you have a $25,000 required minimum distribution to take. And you take $15,000 for yourself. And later you say, gosh, I want to give $15,000 to charity.
Well, now we're at 30, which is greater than the 25, 15 and 15.
It's greater than the 25 because you took yours first. The QCD isn't going to work because it's in excess of your RMD amount.
So could I still go up to that RMD amount if I took money first?
Yes, so you could do $10,000 to the charity.
So just to recap in our example here, my RMD is $25,000. I take $15,000 from myself. I only have $10,000 left to play with that I can use for the QCD.
Yes, and you can't go over. So the way that we talk to clients about doing this is to make sure if they are going to do a QCD, they process the qualified charitable distribution first.
Okay.
Before their own dollars. Because in all honesty, we round up on the RMD. And this is because years ago, I had a calculation for a required minimum distribution be off by 1 cent. Imagine distributing 1 penny from an account.
Oh.
So we just round them up a little bit. And so we always go over just slightly to make sure there's no rounding errors.
Not a bad idea. And this is really a great topic to think about, Amy, as we head to the end of the year. And we obviously want to minimize our tax liability. We want to pay as little as we can in taxes within the rules, of course. So this is a great strategy to employ the Qualified Charitable Distribution, or QCD. Amy, if somebody has further questions about this or wants to talk to you about retirement planning and their financial future in general, how do they find you at Thimbleberry?
They can reach us online at thimbleberryfinancial.com. There's a spot to chat with us. And they can also give us a call at 503-610-6510.
50 episodes in the book. Well done as always, Amy. We'll talk soon.
Sounds great, Jag. Thanks.
Registered representative. Securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Investment advisor representative. Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.